Today, I'm going to tell you about my latest undervalued dividend growth stock of the week. With a market-smashing yield, high single-digit dividend growth, and the potential that shares are 7% undervalued, this blue-chip dividend aristocrat and dividend king is very appealing for long-term dividend growth investors. Before we get started, please consider giving this video a thumbs up if you get any value out of our content. If you're new here, you can also get access to my portfolio and latest buy and sell alerts by joining my Patreon through the link below. That said, let's dig in.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
PepsiCo Inc., stock ticker PEP, is an American multinational food, snack, and beverage corporation. Founded in 1898, PepsiCo is now a $191 billion by market cap snack and beverage giant that employs nearly 320,000 people. The company reports results across 7 segments. PepsiCo Beverages North America, 30% of fiscal year 2024 revenue. Frito-Lay North America, 27%, Europe, 15%, Latin America, 13%, Africa, Middle East, and South Asia, 7%, APAC, Asia Pacific, 5%, and Quaker Foods North America, 3%. The company generates approximately 56% of revenue from the U.S., the remainder is generated internationally. PepsiCo runs a simple but very effective business model. It sells cherished beverages and snack foods to billions of people all across the world. This simplicity and effectiveness has allowed PepsiCo to thrive for more than 125 years and build itself a beverage and snack empire. While taste is subjective, there's clearly some common ground among billions of people. I say that because PepsiCo has 23 different billion-dollar brands. That is, brands that do more than $1 billion per year in sales, including the likes of Aquafina, Doritos, Lay's, Mountain Dew, and the eponymous Pepsi. By providing consistent and desirable taste profiles across these branded products, PepsiCo has built up a loyal global customer base seeking the familiar, which allows the company to leverage pricing power and reinforce its resilience. And since beverages and snacks must be repurchased once consumed, the company has an incredible amount of recurring and enduring revenue, which is translated into decades of profit and dividend growth. Indeed, PepsiCo has increased its dividend for a whopping 53 consecutive years. That qualifies it for its status as a vaunted dividend aristocrat more than twice over. It's a dividend king and a quintessential one at that. Its 10-year dividend growth rate is 7.4%, which is very solid for a large, mature company multiple decades into its dividend growth story, although more recent dividend raises have trended closer to the mid-single-digit area. And you get to layer that dividend growth on top of the stock's yield of 3.9%. To see a stock of this stature offer a yield this high is honestly kind of shocking. We're in REIT and utility territory here. To put things in perspective, this yield is 100 basis points higher than its own 5-year average. The one issue here with the dividend is the high payout ratio. Based on trailing 12 months core earnings per share, that number is 72.5%. Making matters worse, the dividend is sucking up pretty much all of the company's free cash flow. While I don't see the dividend as being in immediate danger, and while I'd really like to see a larger margin of safety here, the bigger issue for now is that dividend growth will be limited to, at best, whatever the business itself can generate, although dividend growth should actually be lower than business growth in order to get the payout ratio down a bit. Despite that quick warning, this remains a dividend king with the utmost commitment to its outsized dividend. For income-oriented investors, it's awfully appealing to be able to capture a near 4% yield from a world-class consumer products company. As appealing as it may be, though, that largely draws on past data. However, investors must always be thinking about the future as the capital of today gets risked for the rewards of tomorrow. Thus, I'll now build out a forward-looking growth trajectory for the business, which will be useful for the evaluation process. I'll first show you what the business has done over the last decade in terms of its top line and bottom line growth, and I'll then reveal a professional prognostication for near-term profit growth. Lining up the proven past with a future forecast in this manner should give us a base of information upon which we can start to draw conclusions about where the business could be going from here. PepsiCo moved its revenue from $63.1 billion in fiscal year 2015 to $91.9 billion in fiscal year 2024. That's a compound annual growth rate of 4.3%. For a mature company that was already more than 100 years old and starting off with a sales base north of $60 billion, compounding the top line at a 4% plus clip annually, it's actually quite solid. Meanwhile, earnings per share increased from $3.67 to $6.95 over this period, which is a compound annual growth rate of 7.4%. We can see that dividend growth and earnings per share growth over the last decade have mirrored each other precisely, showing deft control from management. Consistent buybacks help to drive excess bottom line growth, with the outstanding share count down by more than 7% over the last 10 years. Again, for such a large, mature company with what could be described as saturated markets, this is very respectable growth. Looking forward, CFRA is projecting a 3% compound annual growth rate for PepsiCo's earnings per share over the next 3 years. This would represent a more than 50% deceleration in bottom line growth relative to what PepsiCo generated over the prior decade. While CFRA lauds the company's quality and earnings resiliency, as well as the power of its various brands, it's hard to ignore recent organic volume trends. PepsiCo's growth of late has been driven by price taking, which stemmed from inflation hitting the company's input costs hard during the pandemic, but this taking of price, it hurts volumes. Consumers are simply scaling back on purchases as costs rise. In addition, there's the ongoing question of what GLP-1s will ultimately do for demand for the types of beverages and snacks that PepsiCo offers, although the company has been shifting its portfolio toward healthier options through both in-house moves and acquisitions. The company's 2025 acquisition of fast-growing prebiotic soda brand Poppi for just under $1.7 billion is a perfect example of this. I think CFRA's caution is warranted, and it's fair to assume modest growth out of PepsiCo over the next few years. However, as prices settle, margins stabilize, and the healthier portfolio starts to shine, something closer to the company's historical growth rate could certainly return. Meanwhile, those getting in now are locking in that near 4% yield while awaiting the tide to turn. Before I get into the company's financial position, I want to mention my Patreon offer once again. If you're not familiar with my story, I went from below broke at age 27 to financially free at 33 in just 6 short years by aggressively saving and putting my money to work with undervalued, high-quality dividend growth stocks similar to the one I'm talking about today. I'm now able to live off of the growing dividends my portfolio produces thanks to buying these stocks when they're trading at discounts. I'm making my real money portfolio available exclusively to patrons for just $8 a month. I think this is a bargain for anyone interested in building their own income-generating dividend growth portfolio and following along to see exactly what I'm doing with mine. Patrons not only get access to my entire portfolio, but they also get an alert every single time I buy or sell a stock, as well as my analysis on why I'm making those moves. You can join by clicking the link in the pinned comment below. Moving over to the balance sheet, PepsiCo has a good financial position. The long-term debt-to-equity ratio is 2, while the interest coverage ratio is 14. Because of low common equity, the former metric looks artificially high. Further assuaging shareholders should be the fact that PepsiCo commands excellent investment-grade credit ratings, A1 Moody's, A+ S&P. Profitability for the firm is outstanding. Return on equity has averaged 51.8% over the last 5 years, while net margin has averaged 10.1%. ROE has been boosted by the balance sheet, but return on invested capital is often in a high teens range. Despite slowing growth, PepsiCo is still one of the world's foremost branded food and beverage companies. And with economies of scale, a global distribution network, IP, R&D, brand power, and barriers to entry through established retail relationships with dedicated shelf space, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Regulation, especially with the stance of the current HHS, could be an even larger hurdle for the PepsiCo company and its slate of processed foods. Adding to the regulatory pressure, there are general and changing consumer trends toward healthier foods, a trend likely to be accelerated by GLP-1s, which may negatively impact sales across some of PepsiCo's products that lean more into taste/enjoyment than outright health. GLP-1s may reduce overall demand for food consumption generally, which would be a negative for PepsiCo. Technology and the rise of alternative forms of media make it easier for new entrants to come into the market, advertise, make themselves known to consumers, and compete with entrenched giants like PepsiCo. PepsiCo must continue to navigate different tastes in different markets, as well as evolving consumer tastes and preferences globally. The company's international footprint exposes it to exchange rates and geopolitical risks, such as tariffs. Input costs can be volatile. Passing on higher costs by raising prices on products can lead to lower volumes and strained relationships with retailers. The balance sheet isn't as strong as it used to be, which somewhat constrains PepsiCo's broadening through acquisitions. Because of the law of large numbers, PepsiCo's large size and thorough market saturation may be a serious headwind for future growth. This isn't a risk-free proposition, and no business is, but the stock's 25% drop from recent all-time highs seems to compensate for plenty of risks already. Stock is trading hands for a price-earnings ratio of 18.6 based on trailing 12 months core earnings per share. This is a stock that usually commands an earnings multiple of well over 25. Its price-to-cash flow ratio of 14.7 is further evidence of how undemanding the valuation has become, comparing favorably to its own 5-year average of 17.8, and the yield, as noted earlier, is significantly higher than its own recent historical average. So the stock looks cheap when looking at basic valuation metrics, but how cheap might it be? What would a rational estimate of intrinsic value look like? Well, I valued Cheers using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 5.5%. With the payout ratio being as high as it is, along with the near-term expectation for fairly slow bottom-line growth, I don't see room for dividend growth to come in much higher than this over the foreseeable future. The company's most recent dividend raise came in at 5%, and I think that's a good baseline upon which to build realistic expectations from here. It's actually quite possible that dividend growth over the next year or two is even lower than what I'm modeling in, but I'd anticipate a slight bounce from there once business normalizes and its higher growth, healthier portfolio starts to shine. I'm leaning conservative here, but I do like to err on the side of caution. The dividend discount model analysis gives me a fair value of $133.40. My model shows a more appropriate level of valuation after the stock's big drop, but will now compare that valuation with where two professional stock analysis firms have come out at. This adds balance, depth, and perspective to our conclusion. Morningstar, a leading and well-respected stock analysis firm, rates stocks on a 5-star system. 1 star would mean a stock is substantially overvalued, 5 stars would mean a stock is substantially undervalued, and 3 stars would indicate roughly fair value. Morningstar rates PEP as a 4-star stock with a fair value estimate of $166. CFRA is another professional analysis firm, and I like to compare my valuation opinion to theirs to see if I'm out of line. They similarly rate stocks on a 1 to 5 star scale, with 1 star meaning a stock is a strong sell and 5 stars meaning a stock is a strong buy, 3 stars is a hold. CFR rates PEP as a 4-star buy with a 12-month target price of $170. Perhaps my model was too cautious. Averaging the 3 numbers out gives us a final valuation of $156.47, which would indicate the stock is possibly 7% undervalued. Here's the bottom line, guys. PepsiCo Inc. is an iconic snack, food, and beverage company with more than 125 years of successful operations. Although growth has slowed, this remains one of the premier businesses in its field. With a market-smashing yield, an acceptable payout ratio, high single-digit dividend growth, more than 50 consecutive years of dividend increases, and the potential that shares are 7% undervalued, this blue-chip dividend aristocrat and dividend king is ripe for long-term dividend growth investors to consider picking. Thanks for watching.